Miss Jolly, I think we can start.
Hello, good evening all of you. Am I audible?
Hello. Yes, now we can hear you.
Okay. Okay, let's start. Before we begin, I would like to inform that this meeting shall be recorded and the link shall be shared on our YouTube channel. Afterwards, we will share with your teacher. Okay. And now, as you know, we have 3 partners, USO and IDOBRO and Capital. USO is organizing this program. IDOBRO and Tata Capital. Your mic, camera and chat have been disabled now. We shall activate the chat during the question answer session towards the end of the webinar. Others, next slide. Okay, I think we can start now.
Next, keep going. DhanGyan wale mein chalo.
Behzad sir. Hello.
Yes.
Okay. Yes, shall we start now? Miss Nina, I would like to invite Miss Nina, Secretary General of USO. She will just give a description of DhanGyan.
Thank you, Miss Jolly. Good evening, everybody. Good evening, Behzad sir. How are you?
Good evening. I'm well, thank you. I hope everybody
Sorry,
is well
we
too.
were having a little quiz, so we are a little late into starting the webinar.
No problem. We will carry forward the entire room.
Right. So I think you broke off there for a minute. Right. So I think this is day 3 of our webinar, and I don't mean to repeat. If there are new students who are joining us, welcome. I think we all know what DhanGyan is, so not going to go into the details. We've been hearing this word for quite often. I think you will even, if I go into the description, you will even dream about DhanGyan. So you all know that this is day 3 of our webinar. For the students who are enrolled in this program, you please, once you log into the portal of DhanGyan, you have to do the first 5 modules: the SMART goals, budgeting, insurance, investments, and banking. So today's webinar is going to be on investments. Next slide, please, Adarsh. Yes, so we have done 2 webinars already. We are going to do one today on investments, and tomorrow, same time, we are going to have one on my favorite subject, which is banking. So I hope you all are ready for today's, and I know today is going to be a very interesting webinar, since it's our 3rd day. And the reason for that is because it's on investments. Everybody wants to invest, and I think we need clarity to know where, how, and what are the best sources to do so. And Mr. Behzad, Bhesania is joining us again in order to explain to us about investments or the basics of investing and so on and so forth. So, sir, shall we start? I'll hand over the mic to you now, the virtual mic.
Thank you so much. And welcome, students. So let's start with the basics. Why do you invest? You invest so that the value of money that you carry today does not remain the same as the value of money that you carry at a future point of time. And why do you want it to grow? You want it to grow because that value of money is going to buy you goods and services at a future date, or help you in terms of your financial goals at a future date. So investment planning is a very, very, very critical aspect of your SMART goals, which you learned on day one. So why would you invest is what we discuss. How will you invest and how will you plan your investments are very critical aspects that probably we will try to touch upon today. I'd like to share my screen and probably guide us through certain aspects of investment. And so where would you invest? Okay. Now in your investments, you would plan certain types. One is investments which are high risk and high return, or investments which are low risk and low return. So low risk and low return are usually called debt instruments, and high risk, high return are like equity instruments. Now, as and when you proceed or progress in your lifespan in terms of investment, you would like to create a portfolio which has got a balance mix of what you want to invest in debt type of securities and what you want to invest in equities type of securities. What you want to do in terms of high risk, high return, and what you want to do in terms of low risk, low return. Why is this important? This is important because you need to have a balance in your portfolio. And when I say balance in your portfolio, it means that every time you take a risk, you risk losing your principal completely, or you can have an opportunity to double your principal. If you double your principal, fantastic. But if you end up losing your principal, that is the amount invested, then it may be a cause of concern, and no one would want to do that. So investments need to be planned in a scheduled manner, and we need to know how we need to set our goals such that we do not end up in a very challenging scenario of losing our invested money, our hard-earned investment. Now, as and when we grow in our age, when we are younger, we like to take higher risks. We like to do investments in higher risk instruments so that we get higher returns. And as and when our lifespan goes on, we settle down, we have a family, we have parents who will be elder and will be in old age. We will need medical insurance and all these aspects. So investment planning needs to be defined at various points of time. When you are 20, what are your investment goals? When you are 30, what would be your investment goals? When you are 40, what would be your investment goals? And so on. In your lifespan, when you are a student, you would invest so that you can use this money for whatever new needs or wants that you would have in your lifespan. When you start earning money between the age of 21 to 60, you would like to invest your money and keep it safe and grow it in a manner that you can use it at a future date for your family and children. And when you're 60, you would like to have a corpus in terms of ensuring that at your retirement, you are well in terms of money, because at that point of time, you will not be earning any new money. You will be only earning interest or investment income on the principal that you had invested earlier. So it is very critical to start early. The earlier you start, the better it is. The larger the corpus you can create, and hopefully everybody can be well, stable, and settled in the lifespan that they intend to follow. We will see some manual formulas in Excel. Okay, I know everybody is very, very well versed with Microsoft Excel, I hope, and we will see some basic formulas. If we were to invest on the first year, on the first day, 12,000 rupees, 1,000 rupees every month, Okay, what is the return that I get on a normal fixed, let's say a fixed deposit or a fixed income schedule? Let's say that the fixed deposit gives you a standard 6% return. Okay, so this 6% return over the 20 years will give you 38,500 rupees. You would say, sir, 12,000 going to only 38,000 in 20 years. What kind of limit I want to make? What will I do with 38,000? It is as almost nothing but ensure the of my low. This is the beauty of planning. This is the beauty of how you need to understand the breakup as to where you need and how you need to target your eventual goal. So if I were to tell you that students, today you have got 12,000 rupees in, please invest 12,000 rupees in a fixed deposit, and there is no risk at all because the fixed deposit will always remain. The bank in which you do the fixed deposit also remain, and hence you will have a stability in income or at 6% per year, and your income will grow at the end of 20 years to 38,500. But do you know that what will we buy the same thing not 38,000 rupees? No, that is called inflation. The value of goods that you can buy today for, let's say, 12,000 rupees may not be the same. The value of money changes. How the value will change? And are your investments keeping in pace with the value of money that has changed over time? In terms of planning your financial goals of future, and what is the value that you have for your financial goals? Now, you would see in this chart that steadily 12,000 rupees is growing for 20 years and going down to 40,000 rupees. Now, right, happen. Because interest rates may come down and give you lower rate of interest. It may also happen that you may want to use the money and hence you may not keep it for 20 years. So investment also needs a time horizon. A time horizon means that you should schedule yourself properly to ensure that you will promise in horizon for a continuous period of time. Unless and until something exceptional happens, you would promise yourself to continue to so break the chain. If time schedule investment that you had, you will have to reset yourself. You'll have to restart yourself to ensure that you reach your financial goals within the time that you had decided to. So, friends, we've seen that investing 12,000 on day one will not do real justice in terms of investing your money. So what would we do in terms of choosing the type of investment? We said one type of investment is debt investment. One type of investment is equity investment. The other type of investment is commodity. Okay, commodity could be anything, as today most popular. So you can invest in various forms in a gold instrument. It could be a mutual fund, it could be actual physical, it could be any other form of this investment. The government wants to come out for gold, and that can be in that form. Insurance, we also covered yesterday or did yesterday in our lecture, where insurance is also a critical part of their entire investment planning. Now, Coming back to the sheet, what are our needs? What are our wants? And what are our investments? We follow the basic principle that today, when I'm starting to invest, and if I earn some amount of money, I will spend 50% of that money for my needs, for my basic needs, maybe 30% of it in what I'd like to do, and at least keep 20% present. As and when we grow, this ratio should turn backwards to say 20% towards our needs, 30% towards our wants, and we can start investments slow, but we need to quickly transition to this ratio so as to ensure a healthy, stable, as well as a lifestyle which is backed with financial stability. Now, who doesn't want to be rich? Everybody wants to be rich, but can this come on day one? Absolutely not. It requires A, proper planning, B, disciplined time that we need to invest so as to ensure that our portfolio grows in that manner. So, the investment at the end of 20 years. Inside the graph showing graph, and I could put more money. And if I put 1 lakh rupees, I will get 3 lakh rupees. And the more you put today, the more you'll get next. But the fact is that you will only get a return of 6%. Whatever your investment amount today, whatever it buys today, may or may not be able to buy 20 years from now. Hence, we need to be a bit smart about what we want to invest and how we want to invest. Yes, some component of the portfolio, like we earlier discussed, would be in debt. Some component would be in equity or high risk, high return type of portfolio and low risk, low return type of portfolio. So do we say we should not invest anything in a low risk, low return? Absolutely. We need to balance our portfolio. And when we balance our portfolio, we need to ensure that we keep a good quantum of our investment in fixed income returns and a good quantum in equity. Now, what did we learn till now? Investment goals and the time period. If your investment goals are big and the time period is short, that means you'll need to take higher risks. If your investment goals are limited and the time period is longer, that means you can take a balanced risk. So you need to first define what is the investment goal that you want to achieve. What would you like to do? For example, at the age of 25, I would like to go for a world trip, or I would like to do higher studies in a university in the USA or maybe United Kingdom or Australia. You want to do higher studies plan so that at that point of time, your investment is already having that you need to pay for the fees of that higher education. Or you would say at the age of 35, I would like to buy a house. What would you do to ensure that by the age of 30 or 35, whenever you'd like to buy a house, you would be ready with the money that you need to buy a house? So this is some things that we need to study. This is some things that we need to assess. These are some things that we need to learn. What is your goal? What is your time period? And how you will break up your investments in these factors so as to achieve your financial goals. Now, I'm sure all our students out here have learned the basics of mathematics. And in mathematics, there is a magical word called compounding. And it is such a matter, you can really, really use this in your daily life, in your investment portfolio, and reap good returns. Well, as we all know, compounding is that when you invest your principal, you earn interest. And in the next year or in the next period, you earn the next interest on the cumulative amount of the original principal plus the earlier interest earned. So compounding will help if you have a larger tenure, a larger time of investment, and a factor of invested amount on a regular basis. So if you were to invest something on a regular basis, you will be able to compound that income manyfold at the end of your period. What I have done out there, we all are aware of our equity stock markets, right? What I have done is that between 2000 and 2000, in January, for example, from the base value, the equity market grew 1% in this month. In February, it grew by 2%. In March, 2.3%. In April, it grew by 0.4%. In May, it grew again 2.9%. Wow. So everybody would feel that fantastic equity markets, we should all go and invest, and everybody can make loads of money out there. No, that is not true. The timing of investment and the period of investment is very, very critical. Nobody can obviously time the best point of time to enter. Nobody can time the best point of time to exit. But all you can do is that park your money for a reasonable period of time in this methodology, in any investment methodology that you do. And if you put it for a reasonable period of time, your money will see a growth, because the investment cycle will see the ups and downs of the economy, of the market, of the entire industry, and it will take care of the stability aspect. What we see out here, that it is very difficult to make fast money out of anything. So we did a simple thing. We say, okay, how about on 1st Jan, we invested 12,000, that is 1st Jan 2001. If we invested the same 12,000 rupees on 1st Jan 2001, what would this 12,000 rupees end up if I would invested equity market after? So we see that this 12,000 rupees would have got me 2,06,400 rupees. Fantastic. This is really amazing, isn't it? That 12,000 rupees has got me 2 lakh. And what was the return? The return that I got on my investment was at the rate of 14% on an average for 20 years. Now, do you think it is a great? Well, it is return, but I have rode all the cycles of the upswing as well as the downswing and ensure that the stability of money remains for the longer tenure that you have been able to invest. This, my friends, is what I wanted to highlight, that it does not mean that if you invest in stock market, you can get exponential returns. Of course, you have to closely monitor as to how it goes, what you need to do, whether you have invested at the correct point of time or not, and so forth. This is what your investment look like. It will grow at the end of the period, but it will have its share of up and downs. It will definitely go up and down, but you need to ensure that you are persistent with your investment pattern during the time that you decide to invest. Do not get worried about these drops and say, oops, there is a drop. I'm going to withdraw from here and put it somewhere else, because you never know, you may be missing out for the next growth cycle after this drop. Now, what we've seen is that investment needs stability, identification, investment needs an initial investment, investments needs a goal. So what did we do? We said we invested 12,000 at the beginning of the period of 2001, and we did not do any further investments during this entire cycle, right? And since we did not do any further investments during this entire cycle, we saw that our money grew from 12,000 to 2,06,000 rupees. Now, instead of investing 12,000 rupees upfront, let us see the magic of compounding, and we invested 1,000 rupees every month from January 2001. Every month we invested 1,000 rupees. At the end of 21 years. This is where we reached at the end of 21 years. Our persistent investment of 1,000 rupees every month has led to an exponential portfolio, or I wouldn't say exponential, but a high value portfolio at the end of period of 14 lakh rupees. Doesn't this make it interesting? So, how did you get this 1,000 rupees? This 1,000 rupees was 20% of your investment of your income that you put towards investment, right? The remaining 50% went to meet your needs. The remaining 30% went to meet your wants. Now, wouldn't you want to grow this 1,000 rupees a month, 1,000 rupees a month to a higher amount at a later date? And as and when you keep investing this amount periodically with a discipline that yes, you will invest this on a continuous basis for the time that you want. So if today you are 15 years old, you would want to say that yes, I can probably invest 1,000 rupees a month for sure. When you become 20, you would want to invest more than 1,000 rupees. When you become 30, you would want to invest more than 1,000 rupees, and so on and so forth. By the time that you would want to, let's say, buy a house, you need to know what is the value that will reach at the end of the term of 20 years. This is how you, my friends, can benefit from the concept of compounding. This is the basic mathematic rule or principles that we have learned in our school, and we have conveniently ignored the power of compounding that can bring us in our investments. Let us see if you are able to grow this investments multiple fold. So if you invest a further 1,000 rupees after every year, what would your investment be? From 14 lakhs, it has gone straight to 26 lakhs. I've just added 1,000 rupees more every month, and this is your result. So imagine the power of compounding that you will be able to gain if every year you just simply increased your investment amount by 1,000. Third year has got it, right? This is the power of compounding. This is where, in spite of areas where you have got a negative return in the month, in spite of the market being, in spite of the equity market or the stock market or the environment or the industry showing a negative return in that particular month, in spite of it being 8% down, 13% down, and 15% down, even at the later stage, you have still managed to achieve your investment goal. And why is it so? It is so because you have managed to ensure that you have covered the entire term that you planned to do your investment. I hope 20 years I can pick up any 15 years or any 10 years in this cycle period. and you can see it for yourself that what this investment money is, and regularly reinvest some more capital. Compounding will take you manyfold into meeting your investment goals. So friends, coming back to what are the areas that we can look for investment? When we say equity, obviously is the shares of a company, or you would want to know specifically as to which type of shares to buy. The stock market or the equity market has got something as A-listed shares and other categories. Why do they do these categories? Because of the type of risk that each company has. That means what? If you invest your money in A-listed category companies, your returns may not be manyfold, but your risk also is a bit stable. If you invest in mid-cap companies are those which are not completely stable and have a particular level of functioning. The A category companies are usually large companies who are of the economy, and they are almost ready to ensure that they are able to take advantage of the upswings in the economy when they come through. The other category of investments are debt investments. Now, how would you invest in a debt investment? In the same set of companies, you can buy either debentures or you can buy fixed deposits from banks, and you can have debt instruments. So debt instruments are generally instruments which we earlier saw in our session that will give you a stable set of return over a period of time, depending on the interest rate that the economy is able to pay to the investor. This can be also in the form of mutual funds. So mutual funds is another type of investments where you have got a debt listed instrument, debt linked mutual fund, or an equity linked mutual fund. For people who would like to have a balance in terms of what type of investments that they want to do in terms of not too risky, but not less risky also. They would like to have a balance. So mutual funds also has an option to do balanced funds. Mutual funds also have options of gold, investments in gold. So mutual funds is another method of doing your investments. Now, you would want to know what is mutual funds. Mutual funds means that instead of you going and buying the entire shares that you hold, if you have 1,000 rupees in hand, if you would want to go and buy and do your investment, you will go and buy one share. Now, let's say you bought one share for the entire 1,000 rupees. The mutual fund would say that I will dilute risk. I will not invest in a company, but I will invest your money in a basket of companies. And they will define that basket. That basket can be defined as either all A category investments, or that basket can be defined as all mid-cap companies that basket can be redefined as all small cap companies, or remember, my friends, the higher the risk, the higher the return, the lower the risk, the lower the return. It's a fee. And because the risk is low, you earn a slightly lower return. And hence, again, we come back to the point as what is your investment goal and how would you want to balance your investment goals. If you are able to balance your investment goals and balance your portfolio in a ratio that you know how much of risk you'd want to take, or you would balance yourself in terms of, I would like to do high risk earlier and low risk earlier, or high risk later and low risk later, depending on the amount of money you would want to earn at the end of the and financial goals. Which I hope I have been able to give you
So I think you froze there.
some good insight in terms of the basics of investment. Okay. Okay. So so can you tell me, where I?
Yeah, I think today you were getting disconnected in between, or at least I wasn't certain if it's just our network. But I think while you were summarizing, you were saying that high risk, high return. What is the goal that we want to set for ourselves? I think that's where you sort of got a little frozen.
Yes. Sure. So I will just reiterate on that. So what we learned today is goals. High risk, high return is the principle that we know, but that does not mean that it does not come with the set of issues or the commitments that you need to do on a timely basis. So what we need to do is, we need to define our financial goals. We need to define the time of investment period, time or investment period that we are going to ourselves to do this investment. This is very, very critical to ensure that we are able to achieve our financial goals at the end of the time. We need to list options. We need to select whether we want to do an equity investment. In the recent years, there were a lot of buzz around cryptocurrency and the investments around cryptocurrency, and the regulators would want to regulate it, and there is a lot of buzz around it. Whether it is safe, whether it is not safe, whether it is high risk, high return, whether it is something that may just be stopped in the future because of regulatory guidelines, we don't know much about it. And because of this high risk, high return element, you need to be sure the method that you would invest your money in, how you would want to keep your money safe for any kind of eventuality. So if you have to invest, you need to have at every point of time. At the end of 10 years, what do you do? At the end of 20 years, what would you do? There are other kind of debt instruments that we would like to touch upon, is the government securities. Now, what are these government securities? For example, you can invest in a public provident fund, you can invest in a pension fund, and these are certain investments that are allowed to ensure that our portfolio is balanced and we have kept some money for and future. My friends, business I hope you'll be able to plan your investment goals better. You'll be able to plan what you want from your money invested today at a future point of time. Before we end, I would like to show you one more magical method to ensure that what you do is right, assessed in a correct manner. Again, we come back to Microsoft Excel. When you do a period 2, and say that okay, next year I will invest, let's say 12,000 rupees, like we had in our example. Okay, and at the end of 9 years, I invest 1 lakh. Excel gives you a beautiful and it will do the entire return of the period of investment and the return at the end of the tenure that you will get. And you can use this principle on anything, whether you pay insurance premium on a regularly basis and at the end of the day something of it, whether you do it in equity, whether you do it in debt, you can just simply make the sheet, use this formula, and ensure that you figure out whether your investment is making the requisite set of money or not. Nina ma'am, I would like to open the chat for questions from our students so that
Sure, sir. So I'm going to start the chat. Please do not repeat your question. Just a reminder to the students, kindly do not repeat, just type your question once. Okay, I think the chat has been enabled. So I think one has made sure that we read his the first, at which I think he meant age. Can we start investing, and how can I invest in market?
Okay, there is no age to start. You can start even today. There is no problem at all. To invest in the stock market, all you need is a demat account with a particular bank, a bank account. And since you right now would be below the age of 18, obviously,
yes,
monitoring or running of those accounts. And very simplistically put, you can just continue to invest on a monthly basis the way you want. You can pick up any stock. You want to pick up a market, particularly you want to pick up investing in the index. It is absolutely your choice as to how you'd want to invest.
Right. So Ritesh is asking, sir, what is the best thing to invest in, gold or property?
Well, you know, Ritesh, in over 25 years, even property has gone up in a big scale, and even gold has. What is your investment goal is important. If you already have a house, if you already have shelter, and your goals are different, that you would want to, let's say, move to a foreign country, if you would want something else out of your money, the investment goal should ensure the type of investment that you make. Obviously, what we were trying to say out here is property is very highly valued. You may not be able to invest everything on day one. So if property purchase is your goal at the age of 35, you need to ensure that you do investments in a periodic manner up to that age so that you are able to buy that property. And of course, every type of instrument will grow in a particular and in a particular growth rate for longer period of time. Even property, if you buy a property in a wrong location, in a location that may not appreciate in the future, your investment will get stuck. Similarly, in gold, there may be years when gold may not grow in terms of returns on a very fast pace. So you need to be very sure where you invest your money, how you invest your money, and it is just commitment, sheer understanding, and the tenure of financial goals that you would want to achieve. That's the basic fundamental that you need to do.
So Himanshi is asking, what are mutual funds?
What's the formula? There is no formula to this. Just basic principle. We learn, obviously, what do we see in a cricket match? In a cricket match, see that the players try to ensure that they do their basics right. If they do the basics right, they are able to get their runs. If they don't do their basics right, then they might get out in a silly manner. So do your basics right and the formula will automatically set up for yourself. You don't need to worry much about it. Just ensure you have your financial goals and just ensure that you have your tenure or the consistency of investment or the continuity. Here she says, what I'm somebody or some company offers a basket to you, a basket of investments. So if you had 1,000 rupees today, you would want to go and buy something in the market. What would you buy? You would buy, let's say, one stock of one company. But if you invest the same thing in a mutual fund, you will say, okay, I will make we'll have all large companies, or I will make a portfolio which will have all mid-cap companies. What has happened out here is that your 1,000 rupees has got invested in that mutual fund unit, which has companies instead of one company. You have a lower in terms of exposure to any one company. Once your risk goes down, of course, pro rata, your returns will also go down, but that is the rule of risk and return in investments. Anand mentions investment should be done on the basis of, well, if I understand your question correctly, it should be done on the basis of whatever is your financial goal. If your financial goal is large and you are capable of taking high risk, to a high risk, high return method, if you would feel that amount, then I will be stuck in my progress in life, and hence you may want to moderate your risk. When you moderate your risk, you will be able to ensure that you grow, but in a steady manner. And exponential growth will only come at a point of time when you are committed for a longer period and your investment goals are properly planned. Dakesh mentions what is commodity market. Well, while the same thing as equity market, equity shares of the companies are traded on equity market. In a commodity market, the commodity are traded. For example, commodities could be anything like precious metals, gold, jewelry. These are commodities. It could be anything like there's a commodity exchange in India, and you can trade on the commodity exchange. Well, again, you need to be very, very careful. You need to understand what you're trying to invest in rather than just jumping into it just for a trial basis. How do I find if it is secure to invest? Well, like I said, there is debt, there is equity. Security of investment is nothing that anybody can be aware of. If everybody was aware that it is safe and secure to invest and there is no risk, then nobody would get any kind of better return. A secure investment. The more you understand the investment portfolio that you're trying to invest in, the more you will understand the interest rate and whether you want to go ahead with that element of investment. So the more you understand about debt instruments, you would probably want to be in debt. The more you understand about equity instruments, you would want to say, I want to invest in the equity market. Shubham says, sir, what is the meaning of debt and equity? Well, this is the basic principles of a company. What is equity? First, I will touch upon that. When somebody sets up a company, what is the basic requirement? The basic requirement is that I need capital for that company, to run the company, to run the business. That capital is contributed by a few people. When you contribute that capital, whatever profits you get from that business will go to the shareholder. So equity is invested by the equity shareholders. And whatever all, if good profit, equity shareholder will get the return. If the business makes a loss, the equity shareholder will have to put in. But what is the meaning of debt? The meaning of debt is that the same company wants to in equity on his own. So he goes to, let's say, a bank and says, so the bank will give him some money, but the bank will say, I do not care whether you make money in your business, whether you make profit or you make loss. I want 7% rate of interest fixed on my money. Debt. Debt is fixed rate of interest which has to apply to the provider, but no exposure to the risk of the company making losses or the upside that the company makes profit. If the company makes profit, the debt holder will still get 7%. If the company makes losses, the debt holder will still have to be given 7%. So the difference between debt and equity is that in equity, you are taking the risk as when you have to become a part shareholder of the company, a part owner of the company. When you become a part owner, that means whatever ups and downs the company gets, whatever ups and downs the company faces, you will also have to bear or gain from that ups and downs. But as a debt holder, the defined rate of interest will be given to you. So can you only invest in Bitcoin or property also? Well, Daniel, like I mentioned, it is better to have a diversified portfolio. Why I would say a diversified portfolio, so that something may make better return, something may make lesser for you. And the skill change, like I said earlier. Sometimes gold will be giving you a better return, and sometimes property may give you a better return. But if you bought a property in a place where it has not been so great to grow, then probably gold will grow better. So whatever decision you take, it is better to have a balance in terms of how you invest, in terms of what you invest, and it is good to know the risk in what you are entering into, whether it is high risk, whether it is low risk, and whether you want to absorb or accept that risk. Samiksha says, what is the best age to invest or start investing? Samiksha, why don't you start investing today? Why don't you just open a bank account with the help of your parents as a guardian and just on a monthly basis and see how your money grows in terms of what ways to start if you've not done investment is today. And today does not come with any related age. Wherever you start breaking up whatever you get as your pocket money, as your investment, go to your parents, tell them, okay, Dad, Mom, can you hand me 1,000 rupees? I would like to invest. This will improve your discipline in terms of using money, discipline in terms of investing, understanding of the investing in instruments, and possibly if you stabilize your investments, you will have a bigger corpus at the end of the period. Ritesh said, sir, what is the, sorry, please repeat, what is the schedule of spending money from us? Well, the schedule of spending is very simple. What is it that you want in your financial goals? Do you think that you want a very large corpus in a very small period of time, a very short period of time? Then your investment goal will require you to invest a very big amount. But if you start early and you want to ensure that you get to that corpus at the end of 20 years properly, then you can probably follow the principle of enjoying 50% of your money, using 50% for whatever lifestyle activities you'd like to do, and 20% of investment. But very fast, you will have to turn this ratio into ensuring that a large sum of money goes into investments and securing your future, because that future will ensure stability, not for you, but for your education, your family, your house, and your future family, as well as when your parents are not or no longer working. At that time, you will be able to financially support them. Is investing in online safe? Well, yes, it is pretty safe. You need to ensure that you follow the requisite protocols on your side. You need to ensure that you do not give your passwords, you do not give your username, you do not give your PIN codes, etc. to anybody. If you do that, then you will ensure, or you will be safe in terms of online investments. Just be sure that you are visiting a place, you are not going to any place for investments which promises you double in 50 days or double money or something like that. These scams are quite repetitive and quite happening. Please stay away from this. Please understand where you are investing your money. There is no shortcut to make money. Plan it, schedule it, have your investment goal, and be disciplined about it, and you will ensure by the time you will have a good investment amount. What is the formula for calculating compounding interest? Well, it's very simple. You know, PNR, principal, N is the period, and R is the rate of interest. It's all there in mathematics. You take the number of years, you take your principal, you apply the rate of interest, and you will get your formula that at the end of that many years, you will get your return. Adi says, which business needs low capital and high profit? Well, don't we all want to know that? What needs less money but gives me more in return? Adi, there is no fundamental principle yet. There's no that you like to invest in your daily life. So, for example, pick something out of your daily life and see what you can transform. If you know Mr. Samir Bhatia was the guy who invented Hotmail. Hotmail was the mechanism to ensure, it was one of the first mechanisms to ensure that two people could write an email to each other. Instead of writing letters, they could transmit something in an electronic form. And instantly, that was the requirement of the age, the time at that point. He wanted to communicate with his family. He found this method and he made it into a great big company. He sold it and he had millions. Steve Jobs, he thought about computers. He thought about Apple, Bill Gates. Everybody has come out with something at a point of time, which was the necessity of life or the necessity of making life easier. Today, you have got UPI apps, right? In UPI apps, you just go to Google Pay, click on the picture, and your money is transferred. Transfer of money was so difficult in an earlier day. You used to do through a check, you give to a bank, you used to take 3 days to get the money transferred. Now you can get instant transfer of money. So pick up something in your daily life you feel that will solve the problem of the people. And if you feel that that idea of solving the problem of the people is done, then you have got a big business and you can make big money and high profit. How much do you expect to earn on this investment? Is this realistic? Well, you have an Excel model, you have the equity markets, you know what the equity markets have given you in the past. Generally, past trends do not mean that in the future you will make the same amount of return. Instead of the 15% which I showed you in the Excel, it could be 13%, it could be 20%. It depends on what is your starting point, and it depends on what is the time period that you would want to invest in a committed manner. After what age we should invest in the stock market? Well, you can always invest in any of the instruments in a guided and specific manner or a slow manner. Please understand the type of investment that you want to do and grow in that understanding rather than picking up a phone and somebody says, hey, company A will give you fantastic returns in the next 50 days. Why don't you go and buy it? Do not rely on such random information. Please be sure that you take information, you study the information yourself, you understand the information yourself, and then invest. Better the understanding, better the investment, better the quality of investment, and better the return that you will be able to get. Then says, what is the difference between A-listed and mid-cap companies? Well, A-listed companies are really big companies. Like, for example, Reliance. It's a group of so many companies that if there are any ups and downs in the economy, if India has a phase in terms of the economy, these companies are so stable and so strong that they can get through to this slowdown time. And when the time comes that the country is growing at a faster pace, they will take the country along or take the company along and make high returns. So A-listed companies are generally the stable companies and form a part of the market. Amber says, how on my present age? Well, a very simple method that can I start this line of investing portfolio? Today, in fact, when you're small, I am sure your parents were in bank. It was a big bank. The money on a particular day, put it in the piggy bank. After some time, when you open the piggy bank, you'll be surprised. Wow, there's so much money. So there is no restriction in terms of when to invest and when to start. Just start from whatever pocket money you have, keep something aside and start investing. Yash says, sir, one stock is equal to how much percent of a company? Well, Yash, it depends. If there are only 10 shares in a company and you have bought one, then that would be 10%. If there are 100 shares in the company and you bought only one, that means it is 1%. If there are 1,000 shares, and so on and so forth. So it depends on how big the company is and how many shares you have bought from that company. How to find if it is secure to invest? Well, you have to understand that there is nothing like complete security. Everything has some kind of risk. Even if you do in debt instruments, what if the company completely closes down? He will not even be able to pay you the interest. So while we say debt is a interest-free, risk-free interest return, does not mean that the risk is zero. There is an element of risk, but the risk is so small that there is it is very important to know that if you understand your investment, you will be more secure yourself to the investment. If you understand equity, you will be confident and secure to do equity. If you understand cryptocurrency, you will be confident and secure to invest in cryptocurrency. If you understand all the investment patterns like gold, property, etc., try to understand, try to educate yourself as to what is the best possible type of investment that I can do, and it will be to do a more investment. Nivedita says, what is more profitable, debt or equity? Well, we saw the equity market returns which I showed you on screen. This months where it made loss would be. So you need to ensure what is your investment horizon. Obviously, if your investment horizon is longer than 1 month, it is quite probable that you will make more money in equity than in debt. But that also comes with the fact that equity is more risky compared to debt. And you will be absorbing that risk, whether the company makes money or it doesn't make money. You will be part of that. Sir, our money will increase by investments, but due to inflation, the power of money will decrease. So is the investing in assets like gold and property better than investing money in bank or mutual fund? Shritesh, you know, there is no fixed formula like I explained earlier. It is not necessary that you invest in a property and that property will give you multifold return in a particular time period. Okay, if you had a investment in gold, but when you want to exit, the gold prices may fall and you may make a loss. So it is always better to have a balance in terms of your investment. Always have a balance. Always try to ensure that your portfolio is widespread. Ensure that 2 or 3 items or maybe more are part of your basket. The more the items that are part of your basket, the better risk diverse you are, the better risks you can absorb. Any ups and downs of property and ups and downs of gold would be taken care. You see, every investment or every type of investment has got a different cycle. It is not necessary that when the property returns are high, the gold return also will be high. It will be possible that property returns are high and the gold returns are low. Or when gold returns are high, property returns are low. Or when gold returns are negative or property returns are not there. Maybe debt instrument may be giving you a more stability. So it is very important to ensure that you have a very stable portfolio. And if in the future you need to meet your investment goals on a particular date and time, you need to know that, okay, do I need to take more risk, or can I take a balanced risk, or can I take lower risk, and plan and invest accordingly. Sir, how can we save tax by investing in mutual funds? Well, there are certain sections in tax where you get benefits of investment. So for example, if you invest in fixed deposits of a bank for a period of more than 5 years, you get an investment benefit. For example, if you have shares in the stock market and you sell those shares, okay, up to 1 lakh rupees of profit, you have no tax. If you have a loss, if you made a loss in selling the shares or the gold or any such instrument, your loss can be carried forward and offset against any other profit that you have made. That brings down your tax liability. So there are many benefits in terms of taxes. Suppose if you have made a gain in some property, if you have bought a property and sold it and you made a profit, and you reinvest that money in property, again, there is a tax benefit for reinvestment. So the more you invest, the tax benefits keep coming. Taxation has ensured that in various types of instruments, in various types of returns, you will be able to either get a tax benefit or you will be able to either save tax in a particular manner.
So you've been very patient in answering the questions, and I'm just being cognizant of your time as well. Shall we perhaps conclude, or I think you've answered a majority of the questions that were posted. Some
Sure.
of them are repeats.
Sure. Let me see if I can take a couple of them, and then
Sure.
maybe I'll take the last 3 of them.
Sure. All right.
So Divyam says, sir, we are only investing in a company, and if we get 50% equity of that company, then do we have the right to take any decision related to that company? Well, Divyam, if you have 20% of that company, still you can participate in the decision making of that company. If you have 50%, you can participate more, and so on and so forth. The more you have your own money higher than somebody else's money in the in the company, you will be the decision maker. But there is a difference between taking a decision based on only shareholding and control. Suppose your decisions are not appropriate or not right for the future of the company. The regulator or the companies, the registrar of companies who overall regulates all the companies can come and control your company, saying that what you are taking as decisions are not in the interest of company and the investors or the other investors who are part of that company. So you must be cognizant of the fact that yes, you can take certain decisions, but if those decisions needs to be in the interest of the company, if not, the other shareholders can go to a regulatory body and request that this control be restricted. Sir, our money will increase by investments, but due to inflation, the power of money will decrease. So is investment in assets like property and gold be better? I think I've answered that question. How much do you expect to earn on this investment? Well, it's not a question of expect, it's about question of discipline on your financial goals. If you are consistent in that, you will definitely make money. That I can definitely say so. How much money you will make is anybody's guess. Nobody can put a finger to that. Otherwise, everybody would have been millionaires today. I'll just try to take one last question up here. Sir, would we invest in the share which is price is too high or a share which we have trust that it will grow up? I don't know which share you have trust that it will grow up. Do let me also know that. But let me tell you that there's nothing like a sure shot mechanism that this will go up. Everything has its own ups and downs. A company has to work in an environment which is the country. In this country, there will always be a demand and supply. More the demand, more the company will be able to provide the goods and services, more the profit it can make. Lesser the demand and higher the supply, the prices and profitability will get impacted. So every company has to go through this economic phase of demand and supply. You would have learned, or you will learn in the future in economics, what is the concept of demand and supply. The moment a company faces this demand and supply problem and are able to solve that, that company will be able to grow at a faster pace. Moment the company is able to find a solution to a problem of the economy, that company may be able to grow faster. For example, like we said, cryptocurrency, or like we said, the UPI payments app, the method of payments. Each one has their own risks and return. The moment you understand the mechanism, well, that is where the investments you can make. But please do planned investments. Nina ma'am, I think that was the last question we would answer, because quite of them are repetitive and or almost similar in nature. I hope I've been able to solve your doubts, and I hope I've been able to give you the basics of investments in a very concise manner.
Yeah, no, indeed. And I think just to recap my main 3 takeaways. I love list of 3s. So my 3 main takeaways was, number 1, you can never time the market. So thinking that, you know exactly the time when the market is low, believe me, it will go lower, and vice versa when higher. And the other thing is, in terms of investing, best to start early. That doesn't mean that as 8th graders you start now, but when you do turn 18, when you get your first job, it is important to start setting that small amount of money aside. And the third thing, as to anything and everything in life, to be successful, consistency is key. That goes without saying for investments as well. So I'm sure that the students learned a great deal. The questions are, I'm amazed at the level of awareness that the students have in asking all these sophisticated questions. I'll have to Google a lot of this myself to sort of come to understand. But great job to all the students. Hats off to all of you for being so aware in terms of investments. I'd just like to take a moment to answer a question that was more specific to our program. Gagandeep, you had asked if there is a test after this. So yes, there is going to be a test. So to all the students who have been registered under the DhanGyan program, you have to do the first 5 modules on the portal, and there will be a test. It will be next week. The links of the test will be sent to your teachers. They will forward it onwards to you. You will be given time, don't worry, but it will be next week. We will try to conclude everything by the 5th of February, because I'm sure all of you have exams going on as well, right? So I think that's all from our side. Mr. Bhesania, thank you so much for taking the time today. And I know it went, a little over time. Thank you so much for answering all the questions. And we will see you again tomorrow to talk about, like I said, one of my favorite subjects, being a banker myself. Banking is our last webinar. To all the students, maybe a little homework. Find out what is the closest bank close to you. Find out what products, if you can, that is, if you have time in your schedule, try to find out what products they are offering. What is the rate of interest? I'm sure you all parents have accounts, your parents have accounts in all of these banks. Try to find out what is the rate of interest on the savings and the current account. So yes, I think that's all. We'll Shubham, very good. You're already well prepared, but that's for tomorrow, my dear. So we will see all of you back here tomorrow, 4 o'clock, for our last webinar. Thanks so much for joining us. So thank you once again for your patience. Yeah. All right. Bye, everybody. Have a great evening. Bye-bye.